Welcome to the Deep Dive. Today we're cutting through the noise of Synovus's second quarter 2025 results.
Right.
Our mission, as always, is to extract the most crucial insights, understand the underlying trends, and really uncover what matters for your understanding of this financial institution. And what we'll explore today is how this quarter delivered some, well, truly standout performances, especially how their unique Goldilocks strategy, blending big bank capabilities with personalized service, is playing out in the numbers.
Absolutely. Synovus delivered a very strong second quarter. You can see significant momentum across a range of key metrics. And this isn't just about good numbers, it's about how they're achieving them. The strategic underpinnings are quite clear, I think.
Okay, let's jump right into the results snapshot then. Adjusted earnings per share hit $1.48. Now that's a robust 28% increase year over year.
Which is pretty significant.
Yeah. And adjusted pre-provision net revenue, which for you means the earnings generated before accounting for potential loan losses, also saw a healthy 7% rise from the prior year second quarter. Those are compelling top-line figures, right?
They really are. And a particularly strong performance, one that really stands out, was in loan growth. Production actually reached its highest level since the third quarter of 2022.
Wow. Okay.
And beyond that, they also reported net interest margin expansion, a notable decline in net charge-offs, and an increase in capital ratios. That includes what's now a record high common equity tier 1 ratio.
So all signs pointing to robust health and solid execution.
Exactly.
Okay, with those strong headline figures, let's turn our attention to the engine room, profitability. What specifically drove that impressive performance this quarter?
Well, starting with net interest income, or NII. The net interest margin expanded modestly by 2 basis points sequentially, reaching 3.37%.
Okay, modest but positive.
Right. It might seem like a small increment, but it was driven by several key factors working together. You had a decline in the cost of deposits, the repricing of fixed rate assets coming through, some hedge maturities, lower cash balances, and importantly, a stable Fed funds environment.
So a mix of internal management and a helpful external backdrop there.
Precisely. Each of these contributed to that positive margin movement. It reflects careful management in what's still a pretty nuanced rate environment.
And on the non-interest revenue side, things also looked robust there. Adjusted non-interest revenue climbed 12% sequentially, hitting $131 million. What specifically fueled that jump? Is it, sustainable?
That's a crucial distinction, definitely. The increase was primarily driven by a sharp rebound in capital markets fees. Also, a 2% increase in wealth management income and some seasonally higher commercial sponsorship revenue. But what's more telling, I think, and hints at that sustainability, is that their core banking fees grew a solid 9% year over year.
Right, that's more foundational.
Exactly. This indicates a diversified revenue stream contributing, not just, relying on cyclical market swings.
Their expense discipline seems equally impressive. Non-interest expenses rose only 1% sequentially and 3% year over year. Now, for a company growing like Synovus, is there a risk that too much discipline could stifle necessary investments? Or are they truly striking that Goldilocks balance on the cost side too?
That's a valid point to consider, and it's certainly a modest rise. They're navigating that fine line. If you look at the details, they show a strategic increase in employment costs due to merit increases in new projects, which implies they are investing, just very selectively. Plus, there was a $1 million contribution to a donor-advised fund, basically a charitable giving vehicle that skewed it slightly.
Okay, got it.
But these increases were largely offset by lower FDIC premiums, consulting fees, and operational losses. So the net effect is positive operating leverage. Their adjusted revenue grew faster than their adjusted non-interest expense.
Which is exactly what you want to see, efficient growth.
Precisely.
All right, beyond just the top-line profitability, the lifeblood of any bank is loan and deposit books. And here, Synovus made some particularly intriguing, maybe strategic moves this quarter. Period end loan balances were up $888 million. That's a 2% increase from Q1. Where did this growth come from?
Yeah, the growth was broad-based, which is significant. It wasn't just one area. It was led by high-growth verticals like specialty lending, specifically structured and restaurant services.
Interesting niche.
Yeah, and alongside strong performance in corporate and investment banking and within the commercial bank line and community banking. So diversified growth, a strong indicator. And get this, total funded loan production surged an impressive 60% year over year.
60% year over year. That's a remarkable acceleration, especially in this market. What did management say were the key drivers behind that?
Well, management highlighted a few things. Dedicated effort, for one. The impact of talent they hired back in 2024 and early 2025 really starting to pay off.
Those investments bearing fruit.
Right. And robust lending pipelines. They actually entered the third quarter 14% higher than the second quarter, pipeline-wise.
Wow.
They also noted an improvement in line utilization and a leveling off of payoff activity. So all these factors contributing to that strong loan trajectory, it suggests their strategic hires are, well, quickly contributing to the bottom line.
Okay, so that's the loan side. On the flip side, we saw some very deliberate movements in deposits. Core deposits experienced a 2% sequential decline. What was the thinking there? That seems counterintuitive sometimes.
It does, but this decline was, as you say, quite strategic. It was driven by a clear focus, reducing the cost of deposits.
Okay. Focusing on price.
Exactly, particularly in areas like public funds, broker deposits, and CDs, which can be more expensive. And it worked. The average cost of deposits subsequently decreased by 4 basis points to 2.22%.
So they actively shed some higher cost deposits.
That's right. And the company achieved a 50% total deposit beta through the recent easing cycle. Now, for you, that basically measures how much their deposit costs move relative to broader interest rate changes.
And if 50% is good.
It is. It actually exceeded their own guidance of 45%. That indicates, well, exceptional agility in managing their funding costs.
So playing chess while others play checkers, maybe.
That's a good way to put it. And looking ahead, for the second half of the year, they anticipate core deposit growth resuming, led by core client acquisition, specialty deposit verticals, and some seasonal benefits. So managing cost first, now focusing on growth again.
That strategic foresight is a great point. Now, turning to credit quality and capital strength, always crucial for banks. Net charge-offs were $18 million or 17 basis points. You mentioned that was actually better than their guidance.
It was, yes. Better than previously communicated. And non-performing loans improved too, down to 0.59% of total loans. That marks a 3-year low for non-performing loan inflows. So fewer new problem loans emerging.
That's a very positive picture on credit.
It is. The allowance for credit losses also declined slightly to 1.18%. This was primarily driven by those positive credit trends within the loan portfolio. It was partially offset by a small adjustment based on a more adverse economic outlook from Moody's unemployment rate scenarios.
So still cautious on the macro outlook, but the portfolio itself is performing well.
Exactly. Despite that minor headwind, overall credit performance was strong. It indicates a well-managed portfolio.
And their capital position, you mentioned a record CET1 ratio.
Yeah, exceptionally robust. Synovus ended the quarter with a preliminary common equity tier 1 ratio of 10.91%. That's the highest in the company's history.
Impressive.
And their total risk-based capital ratio also stood strong at 13.74%.
What does that strong capital base allow them to do?
Well, for one, it supported approximately $21 million in share purchases during the quarter, so they're returning some capital while maintaining these record high levels. It speaks to both strong financial health and strategic capital deployment.
Okay, let's shift our focus now to the investor context. This is where we see their forward-looking strategy and how they're positioning themselves. Synovus has updated its 2025 guidance upwards.
That's right. They now expect adjusted revenue growth of 5% to 7%. That's up from previous expectations.
And expenses.
They're maintaining adjusted non-interest expense growth guidance in the 2% to 4% range, so still expecting that positive operating leverage. And net charge-offs are expected to remain relatively stable in the second half of the year.
Okay, and what assumptions are baked into that guidance regarding interest rates? That's always key.
Good question. Their guidance incorporates expectations of 2 Fed funds rate cuts in the second half of the year. Specifically, they're penciling in September and December.
Okay, so 2 cuts this year.
Yes, and they assume a relatively stable 10-year Treasury yield. So it shows they're factoring in a specific, maybe somewhat conservative economic outlook for the rest of 2025.
And how do they look in terms of interest rate sensitivity within that kind of environment if we do get those cuts?
Well, Synovus remains relatively neutral to the front end of the curve, but slightly asset sensitive to long-term rates. They do anticipate some short-term margin pressure during an easing cycle.
Why is that?
It's mostly due to the timing lag between loan repricing and deposit repricing. They estimate about a $5 million to $7 million impact to net interest income per rate cut.
Okay, a manageable impact, it sounds like.
Yes, and crucially, they expect this to be a short-term effect, not a long-term erosion of their margin. It suggests a pretty well-hedged position overall.
Now let's talk about strategic talent and tech investments. This seems to be a real cornerstone of their Goldilocks strategy, right? They're hiring quite aggressively.
They really are. They're on track to hire 25 commercial relationship managers. In 2025, they've already added 12.
And more planned.
Oh, yeah. They're planning for another 30 in 2026 and potentially 30 to 40 in 2027. This is a significant, sustained talent push.
Where are they focusing these hires?
Strategically concentrated in key high-growth markets. Think Florida, Atlanta, South Carolina. And management stated these hires are expected to have less than a 2-year earn-back period.
That's fast. Shows discipline.
It demonstrates a disciplined, measured approach to expansion, definitely. They're also adding private wealth resources to support a business owner wealth strategy, showing a kind of comprehensive approach to client acquisition and service.
Beyond talent, they're pouring significant resources into technology. What kind of capabilities are they enhancing, and how does that fit into their competitive advantage?
Synovus emphasized significant investments here. Things like a new loan origination system, a syndication platform, enhancements to their treasury services like improved onboarding, foreign exchange hedging, advanced payables and receivables platforms.
So the sophisticated stuff.
Exactly. Future projects include ERP integration and a fully integrated payment portal. They've also added liquidity product specialists. These investments are clearly aimed at providing the sophisticated tools you typically find at much larger banks,
while maintaining that personalized, smaller bank service. That's the Goldilocks idea again.
That's precisely where the Goldilocks advantage truly comes into play, offering those large institution capabilities with personalized service.
Does management believe that's really working?
They do. They believe this ability creates this unique advantage in attracting both clients and talent. And it seems to be supported by a strong company culture with high team member engagement. It makes for a very compelling competitive differentiator in, let's face it, crowded market.
Makes sense. Now, even with those record high capital ratios, Synovus has a clear capital allocation philosophy, and it seems to favor growth over buybacks right now.
Yes, they were quite explicit about that. Their priority for capital deployment continues to be loan growth, not share repurchases. They're aiming for a relatively stable CET1 ratio.
So signaling an unwavering focus on organic expansion as the primary driver of value.
That's the message, yes.
And finally, on the regulatory environment and M&A. What are their thoughts there, given their strong capital and strategic positioning? Any hints of deals to come?
Well, the company anticipates a potentially more favorable regulatory environment. That could lead to increased capital flexibility for regional banks, maybe easier M&A approvals down the line.
But is that their focus?
Yeah.
M&A?
Not primarily, no. Synovus remains focused on driving organic growth first to enhance its valuation. They seem to view M&A more as an optionality that might arise from an improved valuation rather than a core strategy itself.
Build value first, then maybe look around.
Pretty much. And they also continue to invest in their large financial institution, or LFI, capabilities. That's just prudent risk management, really, regardless of any regulatory changes.
Okay, we've explored the numbers, the strategy, the capital. Now let's step into the shoes of an investor for a moment for our Not Financial Advice segment. Given everything we've uncovered about Synovus's Goldilocks strategy, big bank tech, small bank touch, it sparks some interesting, maybe audacious trade ideas. One could consider, perhaps, a highly concentrated long position in Synovus itself, betting on that strategy continuing to deliver.
Right. And the outrageous part of this trade idea might be to simultaneously take a short position on, say, other regional banks within Synovus's main operating footprint.
So a pair trade, essentially. Long Synovus, short the regional peers.
Exactly. It would be a very direct bet that Synovus's differentiated approach and, frankly, their robust execution will lead to significant market share capture, taking it directly from less agile competitors.
It's plausible because their consistent execution and those strategic investments we talked about, they are clearly yielding results that seem to be outperforming the market, especially looking at this earnings call and those targeted high growth areas.
It's a compelling story they're telling.
But of course, you have to remember, this is absolutely not financial advice, just for entertainment and information purposes only. Always do your own research.
Absolutely. So just to recap, Synovus reported a quarter really defined by strong performance, disciplined execution, and a clear strategic path forward. They've raised their revenue outlook for 2025, they've maintained expense guidance, and they're projecting stability in key credit and capital metrics, pretty solid all around.
And the core of their success, as management highlighted, seems to lie in their commitment to listening, to clients, investors, team members. That seems reflected in their market performance, their guidance, and that high employee engagement they mentioned. It's a compelling narrative of focused organic growth.
It is. And as we close this deep dive, you should consider this. Synovus is clearly building a foundation for sustained growth. They're focusing intently on organic expansion and strategic talent acquisition to really cement that Goldilocks advantage.
So the big question remains, how much can this Goldilocks strategy truly disrupt what is a highly competitive banking landscape? And will their unwavering focus on organic growth eventually yield to more aggressive M&A, especially given their strong capital position and that potentially easing regulatory environment?
That's definitely what we'll be watching closely. How that unfolds in the coming quarters will be fascinating.